Hi everybody, James Sawley here, Head of Retail for HSBC. Welcome to our second Coronavirus Retail webinar. Today we're going to be looking around the world for lessons from countries that have exited lockdown. And we're also going to be talking a little bit about the outlook for the consumer economy here in the UK. But first, let me hand over to David Maddison. Take it away, Dave.
Okay, thanks, James. As non-essential retail prepares to open its doors on the 15th of June, James and I thought it would be a good idea to share our thoughts on what to expect in the weeks ahead, using HSBC's global presence and reach to see what we can learn from other markets that have already begun the easing of lockdowns and apply some of those anecdotes to the UK market. Before we do that though, where have we came from? The past 3 months have seen UK retail experience arguably the most disruptive period in post-war history, as all shops deemed non-essential by the government instructed to close from March 23rd with little over 48 hours notice to do so. The doors remained shut for over 2 months, with limited segments of retail permitted to open towards the end of May, which included garden centres, furniture and homeware, those which the government determined were safer to do so, with the remaining, as we all know, on the 15th of June. And whilst I say the past 3 months have been the most disruptive and unparalleled in recent living memory, the ways in which operators have been impacted have varied hugely. Online pure players across all segments, from electronics to clothing and apparel as a whole, have definitely fared better than the omnichannel retailers, in the same way as omnichannel retailers have fared better than offline operators. The likes of Boohoo have gone from strength to strength, pivoting from fast fashion-led clothing to lounge and casual-based clothing, mirroring the shift in what consumers demanded whilst refined to the living room and bedroom. Multi-channel retailers such as Dixon's Carphone managed to offset lost revenues from the stores that were closed almost entirely through their online operation, an impressive feat. However, offline retailers such as Primark had zero sales throughout lockdown, losing up to £650 million in revenue for every month closed. Initial thoughts going into this were all aspects of non-food retail would lose out, but this has turned out to be like any other material event impacting the industry, and extremities of winners and losers have become even more polarised. Thankfully and hopefully the worst is behind us, and we can focus and look ahead to the reopening of UK retail by taking note of what other markets have seen so far. So as the path of the virus moved east to west, the Eastern Hemisphere has been the first to re-emerge from lockdown. Looking specifically at, say, New Zealand, which reopened non-essential retail several weeks back, retail spending rebounded surprisingly vigorously. When New Zealand was at alert level 4 being the worst, data from Paymark, which is New Zealand's leading payments provider, indicated that overall retail spending dropped 50% compared to pre-COVID levels, with spending in areas other than groceries down 90%. Now that they're up to alert level 2 and shops are reopening, spending levels are down only 2% on the same time last year, just 2%. This, while still maintaining social distancing protocols, illustrates a significant element of pent-up demand. The next step will be to see if this can be sustained over the coming months. If, like us, you want to keep an eye on this, Westpac provide weekly data analysis on their website. China was one of the first to emerge from lockdown, having been the epicenter of the pandemic. Unfortunately, the most recent data, official data, only goes to April, but the trend from when lockdown was eased from March to April tells similar stories to New Zealand. Whilst March had 2 weeks of lockdown and 2 weeks of easing, the trends show clothing and apparel sales gone from a negative 40% to minus 18%. Sports and recreational articles, or health and fitness as we interpret it, went from minus 7% to plus 12%. Furniture, minus 25% to minus 5%, minus 25% to minus 5%. Cosmetics, minus 12% to plus 5%. The list goes on, and the trends of releasing of pent-up demand the same. In Japan, the fast retail company, which trades as Uniqlo, one of the largest clothing and apparel operators in Japan and Southeast Asia, saw a doubling in its sales across Japan through May compared to April when it opened its doors, but it was still 20% down on last year. But that was also including 20% less stores, so another sign of pent-up demand for non-essential retail. Anecdotes from corporates around the world, Gucci or Kering, they saw trends in mainland China improved since stores began reopening in early March. LVMH, Louis Vuitton, their fashion and leather goods business, recorded a decline in revenue of 10% in the first quarter of 2020 in a market environment defined by store closures in several regions around the world, but online sales saw rapid growth. Watches of Switzerland, the final 6 weeks of the financial year to the 26th of April, were significantly impacted by the ongoing outbreak. All stores within the group's portfolio were closed. During the period following the store closures, e-commerce online performed particularly well. Sales from online increased 45%. During the same period, with a further acceleration during the month of April, where sales increased 82% relative to the prior year. In response to the closure of the bricks and mortar network, the online offering has been enhanced by addition of several brands which the group had previously only transacted in stores, just a sign of a company pivoting to a new strategy to help cope through the virus. Nike, 100% of Nike's own stores and over 95% of the partner stores in Greater China and South Korea are now open, with some still operating with reduced hours. In these markets, retail trends are still progressing. While physical store traffic remains below prior year levels, this has been largely offset by high conversion rates, higher baskets, and continued strong online demand. H&M, which operates globally, saw a polarized world, with France and Italy down a whopping 71% and 80% respectively through March and April. South Korea and China, on the other hand, who were opening up, were only down 11% and 30% respectively. And the one that I find most interesting, which is Primark, they gave a really good update to the market a few weeks ago. Trading in 112 of its stores, which is 34% of its estate, reopened and seen both reassuring and encouraging signs, with customers queuing outside most stores and once in store, spending on large basket sizes. Cumulative sales since reopening on a like-for-like basis were down on the same period last year in aggregate, which isn't to be expected. For a number of stores, sales were ahead of last year. A good number of regional stores were performing well, and only 4 stores had initial sales below 50% compared to last year. This included Damrak, which is in the centre of Amsterdam, and the store in Alexanderplatz in Berlin, the centre of Berlin, which is understandable. Both those stores are in the centre of big cities and are suffering from the current absence of tourism and much lower commuter footfall. Consumer demand, so they've said, has been strong for children's wear, leisure and nightwear, along with summer products such as shorts and t-shirts, reflecting the good weather in the markets where they were trading, although the weather at the minute isn't that great in the UK. With all these points and comments in mind, the picture for the UK appears more optimistic than previously feared. The expectation that the UK will experience a worse recession in 300 years, whilst true from a macroeconomic perspective, consumer economics are somewhat an anomaly. As we stand today, most people are either still employed, furloughed, or receiving another form of state aid. All this, but without the same cost base in most cases. People have either been unable to spend their discretionary income, with shops being closed, or unable to holiday, unable to commute. In essence, eating, sleeping, and working from home, which is in general terms meant costs have been less, while still receiving the same amount of or similar amount of income. As from what we've seen in other markets, a releasing of this pent-up demand should ensue, providing there aren't any seismic changes in the government's policy towards retail, and we don't have a mass second wave. But how long this wave of demand will last is the big question. A few truisms, if I may, which caveat this statement. If an operation was struggling going into the crisis, the odds are it will continue to struggle coming out of it. Pent-up demand will not be a silver bullet unless the fundamentals of the business and offering have changed. The shift to online, which in most non-essential retail cases has been 100% compared to pre-virus levels, which were between 30 and 35% penetration, which will have only accelerated this change, and where this level will end, as an educated guess, ours is between 35 and 40% penetration. Initially, the number of transactions in store will be less, which is by nature of social distancing, but transaction value will increase significantly as consumers who go out to shop are more likely and more willing to part with their discretionary income and are going on a shopping trip purposefully. Stores, products and experience that rely upon tourism, more specifically Chinese tourism, who carry significant buying power, will be impacted potentially harder and for longer. However, operators with stores based in China should see some of that spend offset and diverted to domestic mainland purchases instead. So, what can we expect upon reopening in the UK? What can we look forward to? At the bare minimum, expect stores to be sparsely populated, with numbers limited through social distancing protocols. The knock-on effect will be you may need to queue. This is the bare minimum. One-way systems will likely be implemented in smaller or compacted retail sites to ensure customer safety. Some stores may look to implement a shop by appointment operation, which should remove the need for queuing. For this to work financially, we'd expect it to only be implemented by high-value retailers or experiential or service-led operators. Temperatures, as we've seen in Hong Kong and China, temperatures may need to be taken upon entry of a shop or a shopping centre, and it may become the norm in some places. Whilst this doesn't prevent the spread of the virus during the incubation period or in non-symptomatic cases, it will help customers feel the operator is taking safety and their well-being seriously and should alleviate any elements of stress. A specific issue facing footwear retailers when trying on products is fairly essential prior to purchasing has seen sub-operators publicly state they need to quarantine products for 24 hours prior to other customers being able to try on, which makes the model potentially unviable to operate within profitably. That being said, some lessons out of Spain, Spanish retailers have found a workaround by providing thin plastic-like socks and gloves to customers, ensuring minimal and no contact of the products, so they're able to utilize and turn them around straight away. Some luxury retailers and jewelry retailers are utilizing UV sanitizers to disinfect products after customer handling. Click and collect car services, similar to what supermarkets already provide, ensuring contactless collection, minimizing any potential transmission risk. Well, this will only work if there's a car park. As you can tell, retailers are getting inventive, which is what is needed in times like these. The main objective in my eyes to attract customers is to ensure an environment where they feel comfortable and safe, but also providing enjoyment. Otherwise, customers may as well continue to shop online. And my final point before handing back to James, let's not forget the incredible work retailers and clothing manufacturers have done throughout this pandemic, making PPE, offering their logistics services, but most importantly, let's not forget the people who work there and continue to do so. Over to you, James.
Thanks, Dave. Some really interesting insights there as to what's happening around the world in retail as countries come out of lockdown. In my role, I have the huge privilege of speaking to dozens of retailers every week. And over the last 10 weeks, I've got to say, for the vast majority of our retail customers, optimism and outlook has improved week by week. And this really has been driven by three factors. First of all, much improved online trading. At one point, the threat of closing down all online retail was probably the low point through all of this. Thankfully, that didn't happen. Secondly, positive signs of trading from around the world, as Dave explained, beating expectations. The key trend being lower footfall, but much higher conversion rates and much higher average spend per head. And the third point is really around much more visibility around when we can open our stores in the UK. 15th of June is that big date. And of course, pent-up demand. We've all seen the long queues outside of IKEA, clear signs that pent-up demand is there. What retailers are grappling with right now is forecasting demand, which is why I want to talk about our experiences in other regions. I'm working with retailers on what their like-for-like trading assumptions should be in their base cases and their sensitized cases when asking their banks for loans or seeking additional equity to shore up balance sheets in the future and hopefully finance some growth. What I'm seeing retailers forecast is a huge range, everything from back to 100% store like-for-likes within months, all the way through to still at negative 20% like-for-likes through the best part of next year. And I don't blame them. It is very, very hard to forecast demand in this environment. What will social distancing do? More importantly, what is the economy going to look like for the consumer? Very, very tricky. Firstly, just to look at social distancing. Now, social distancing is clearly the number one way to prevent a further spread of the infection. So it's extremely important. But as we've seen from some of the trading data, and Dave mentioned some of these cases, in other countries, even with social distancing, some retailers are achieving 100% plus like-for-likes in their stores. So it proves that it is possible. Higher conversion rates and basket sizes make this possible. People are in your shop to buy something, not to browse. And when they do, they're spending more. Of course, people will feel safer going into a shop where it looks like there's been a lot of effort put into protecting the safety of customers and staff. So certainly take that very, very seriously. I've heard in a lot of countries that people's willingness to socially distance ultimately has started to wane after a short period of time, if a matter of weeks or certainly months. With social distancing, it's a very unnatural thing to do. You see it now around you. But of course, as retailers, it's very important to follow government guidelines to protect staff and customers as much as possible. But the bigger point around forecasting demand is clearly the economy and the consumer. Over the coming months and years, we will see what consumer spending will look like. Will consumers have the ability to spend? Will they be employed? Will their wages be growing? Will they get a bonus? What will the inflationary environment look like? But then also, you look at the consumers' willingness to spend. Of course, consumer confidence, saving ratios. Now, there's not many people in the world whose living memory allows them to make a real educated guess as to what the economic conditions following a recession that wasn't caused by things like a war, government policy, trade imbalances, the instability of the financial system. So forecasting what the effect of a pandemic is very, very tricky. Since the UK economy was in reasonable shape heading into the virus with modest growth and record unemployment, albeit, of course, with a number of headwinds, Brexit being a good one, it is really, really difficult to call whether it would be a V shape, a U shape, an L shape, or any other letter-shaped recovery. Even now, the Bank of England, UK's top economists, big investment banks, they cannot agree what the recovery will look like. In fact, many of them are poles apart. The more optimistic institutions, like the Bank of England, are forecasting a 14% fall in GDP this year, followed by a 15% positive swing in GDP next year. So that's roughly a flat economic output over a 2-year period. They're forecasting that unemployment will increase from 4% now to 9%, so a big jump, but that will come down from 9% to 7% next year, and will fall back to the levels we're experiencing now by 2023. So with that in mind, let's think about what happened to retail sales during the last recession, the Great Recession of 2008, 2009. GDP fell by 2.2% in Q4 2008, and we saw in total 5 quarters of economic contraction. This combined with unemployment increasing from 5% pre-crisis to 8% in the crisis. And that 8% unemployment pretty much persisted around that level between 2008 2013. But even with this economic environment, the British Retail Consortium and the ONS both reported, on average, total retail sales growth through this period. Of course, non-discretionary categories were more resilient, like food, and discretionary items clearly suffered worse. It was reported last week that consumer confidence is now teetering around the same levels of 2008, but no worse. So maybe it's the unusual nature of what is about to cause this upcoming recession could be the silver lining for the shape of the recovery. GDP has fallen and will fall because of a planned partial shutdown of the economy. So in theory, activity and demand should rebound, particularly given the levels of fiscal and monetary support from the government. Of course, many households will see their incomes under pressure due to job losses, which of course are going to get worse in the short term. But then this is, on the flip side, this might be offset by the fact that many households have saved a lot of money through this. Like David says, that during lockdown, they're still earning the same amount of money, but their cost base is significantly lower. As we've seen from other countries, those retailers and those hospitality businesses serving a more affluent customer base has rebounded more strongly. The same breath, those at the value end of the market, presenting significant value for money to the customer, are also outperforming, as we saw in the last recession. I expect that to continue. So this kind of polarization effect of retail will continue. Those stuck in the middle between value and the luxury end are likely to find it take it longer for their like-for-likes to recover. Following the two key global crises of the last 100 years caused by factors outside of the realms of geopolitics and economics, take the Spanish flu and the 9/11 terror attack, for example, by all accounts, the consumer economy was more resilient and rebounded quicker than what people expected. But given the severity of coronavirus and the reaction to it, and for context, during the Spanish flu, shops didn't even close. The coming 2 quarters, we are highly likely to see, of course, a sharp and deep recession, with unemployment increasing dramatically, especially in industries such as travel, airlines, retail, hospitality. In addition, we're likely to see personal, company, and government balance sheets being stretched. But with low interest rates likely to persist and gilt yields at historic lows, some argue that reducing the deficit may not be an urgent government policy, and we can take our time to grow out of the debt, just like after World War II. All these arguments for and against things like higher taxes being a key one are being made by economists and politicians all around the world. But for me, the most important question is how quickly will demand return? How quickly will people be re-employed? How quickly will new companies be created to pick up the economic slack? I think, based on historic data, we will be pleasantly surprised. I have faith in the entrepreneurial, hard-working spirit of the British people to create new and exciting companies to fill that economic void, and dare I say, move our economy forward, especially in retail. I also have faith in the laws of human nature. They have evolved over millions of years, not months. Our need to socialize, our need to travel, our need to explore new things. All these things will help us recover quickly. So in summary, I'm not suggesting things are going to return to normal straight away. Far from it. Trading will be tough for 3 to 6 months, no doubt. But I honestly believe we will see incremental improvements quickly, just like in other countries, and there will be winners. And let's not talk our way into a prolonged depression. Let's seize the opportunities that recessions present, such as removing capacity from industries, ultimately less forward-thinking businesses, and harness the creative and entrepreneurial spirit of the country. So that's all I wanted to say. I wish you the very best of luck with opening as we emerge from lockdown. Stay safe, stay well, and I look forward to our next webinar, which hopefully will be reporting on positive trading post-lockdown. All the best.